run on the bank experience in the US currently reminiscent with the subprime crisis of 2008, which gave birth for the Bitcoin network. The need for protecting capital was more demanding, particularly when deposits were yielding less returns and both the government and the financial system were working overtime to oppress small investors. It seemed as more opportune time for the Bitcoin to have emerged on the horizon, and that's the reason why financial markets are giving a thumbs up for them. Since then, the most popular cryptocurrency witnessed an astounding surge, reaching an all-time high of $69,000 mark way back in November 2021. So, considering the sequence of events over the last week, we quickly began to recognize the errors of the human centralization. Last Wednesday, Federal Reserve Chairman Powell outlined a new approach to the Federal Reserve's policy path, indicating that the interest rates may continue to rise for the longer period than the previous thought. The expectations started building into the system, which in turn resulted in creating a ripple impact throughout the bond markets. Bond prices dropped drastically because they were inversely relationship with the yields. Silicon Valley Bank was forced to sell some of the 10-year bond on its balance sheet at 20 to 30% discount to meet obligations amid rising withdrawal pressure. As rumors of a cash shortfall began to circulate, a follow-on run on the bank ensued and regulators took over. As the fear of contagion started to spread, the situation exposed more banks for the regulatory oversight. For all accordance to the financial bank rules, most of these banks hold up to 5 to 10% of the capital in reserves. The current economic slowdown led to the apprehension about the cryptocurrencies, and the implosion of the FTX, 3 Arrow Capital and the Terraform Labs suggested that the pessimism would grip traditional finance. But the exact opposite happened because of the Silicon Valley Bank failure directly impacted the stablecoin market as well. As a result, many investors moved large chunk of their money away from the stablecoin and bank shares to Bitcoin as a risk-aversion assets. That's what analysts have said. Well, Bitcoin's beauty lies in the ability to store value in a decentralized manner backed by math, without requiring humans to validate or support it. No one lends out 90% of your deposits to make a profit. There is no possibility of a bank run and no gambles with your hard-earned money on bonds. Bitcoin was essentially created for this moment, and the market provides conformity to this assumption. So it is what we use to store wealth, perhaps selling small pieces for stable coins to pay our daily expenses, but nonetheless only trusting the centralized store of value. A significant shift is underway and more people are opting out for the traditional system. We do not know how long it will take, but the great reset is happening and Bitcoin will be the chosen currency. Will Bitcoin rise to the occasion? That only time will tell. This is Manoj Dara signing off. Keep watching Theodore TV for more such interesting stories and updates. Thank you.